Right, good morning to our wonderful audience and welcome back to Boutiques on Wednesdays as per usual. Thanks to your continued support and great work done by our wonderful fund managers, BCI's assets under administration now exceeds 300 billion. From Robert Walton, Tanya and the BCI team, we want to thank you for your contribution, and none of this would have been possible without you. With that being said, it's my absolute pleasure to welcome this morning the high-quality, multi-award winning team from BlueAlpha, speaking to their investment process, global and local equities. Joining us now are Chief Investment Officer Walter Jacobs, CEO Richard Pitt, Portfolio Manager and Quants Analyst from BlueAlpha, Carl Ricks. Gentlemen, it's a great privilege to have you with us this morning. And we thank you for your time. Very frisky here in Joburg. I believe Cape Town's a little bit better. Walter, I just want to check. I believe you're going to start this session by taking us through your product range and investment process. You can start sharing if you are ready. And then you're going to hand over to Richard on global equity and Carl on local equity. I can see your slides. It's coming through. Absolutely perfect. And gents, you are welcome to start if you are ready.
Okay, thanks, Eugene. Yes, we're ready and kick off. I quite like the music that you played at the start, just for one thing. I think it was talking about the ocean. I prefer the bush, but be that as it may, on this cold day, we'll not be in the bush today. Okay, so let's kick off. For those of you who are not familiar with BlueAlpha, you know, we've been around for quite a while, and most of you probably associate us with equities, but we've been in the multi-asset space actually since the start of the business in 2005 when Richard and Ace launched the All Seasons Fund, our longest running fund. So just brief history, I'm not going to go into detail, just to say that we've been around for a while. And our funds are available on the BCI platform. Going to focus probably mostly today on global equity and local equity, but for the record purposes, these are the funds that's available in the platform, and some more detail on each of the funds. I'm not going to go into that at the moment. As Eugene said, the focus will be on process. So what is our investment process? We define ourselves as a quality manager with a growth tilt, and specifically by quality, we mean the creation of economic profit. So quality in our minds is not something related to a product. It's not something related to an opinion. It is backed up by hard financial numbers in the calculation of economic profit. People will often ask us about valuation, and what we'll say is that that's the last step in our stock selection process. It's not that we don't care about valuation. It just comes last, and that means we're looking at a different opportunity set as opposed to when valuation is the first step in your process. And when we talk about valuation, we're typically referring to a free cash flow yield and not an PE ratio. And the other important point is that we're not macro forecasters. It's not to say that we don't care about macro. We just observe where we are in the cycle, and we know that that has specific implications for stock picking, and we consider that in that way in our stock selection process. So why quality? In our minds, a business cannot survive without generating economic profit, and this conceptual model will just demonstrate the point. So here we have two companies, company A and B, and both earn 100 in earnings. Now, what the market would typically want to say is, what is the PE of these two companies? And want to come up with whether this company A or company B is cheap relative and therefore a good investment opportunity. But be very careful of shortcuts, because just looking at the PE, you don't quite understand what's going on in the business. Valuation is pretty much a function of how much capital is invested in a business, and that can be measured through assets or equity. What return are you making on your assets or equity? And that's the objective measure of quality. And we're looking at ROIC. So company A generates a 20% ROIC, while company B only generated 10. And in this instance, both companies are growing at the same rate. And if you follow the mathematical model through to conclusion, company A should theoretically trade at a price to book or an EV to invested capital of 4 times, while company B, because it's generating ever increasing economic losses, it is worthless. So, think of the likes of Steinhoff, or think of the likes of Nampak, PPC. If you continuously generate negative return on capital, negative economic profit, ultimately the only way that the business can survive is by capital market intervention. So more shares in issue. Otherwise, the business ultimately will go into business rescue and die. So all that we're saying is be very careful of these shortcuts. The last step in the process, thinking about valuation, you first have to understand return on capital, and then you have to understand growth and the economic profit that flows from that. So quality, growth, and risk and valuation are inextricably linked. You can't just look at the final outcome to decide if a business is cheap or not. And why quality is important is that actually these moats are sticky. So this is a study, and there's various studies that's been done on the subject by Credit Suisse, in this instance Counterpoint Global. McKinsey's has done very similar studies that we've shown in the past. And what this just shows is, looking at the Russell 3000 from 1990 to 2022, if you split this Russell 3000 into 5 quintiles, and you said, what is the return on capital for the companies in the Russell 3000, and put them into these 5 buckets, what you find is the best companies 3 years later, 48% of them still remain the best companies as measured through return on capital. And only 15% move from best to worst. And the converse, if you were one of the worst companies, there's a 41% chance that you remain a bad company 3 years later, and only a 12% chance that you move from best to worst. And this is typically what the market loves to do. It loves to try and find these bad businesses that's gonna all of a sudden become a good business. And why is that the case? Well, if you look at total return on total shareholder return, if you were a bad company, just highlight this, if you were a bad company and you now become one of the best companies, you generate a 33% return. So yes, there is money to be made from this, but the chances of that happening is quite low. Whereas if you just remained in a best company, you'd still generate a 20% return for the shareholders. It's something not to be sneezed at. So it's clearly important, though, to try and understand how you're moving in these buckets. Because if you were a good company and you now become a bad company, that's going to have significant implications for your investors. And so our process needs to be quite clear on identifying companies that's going to remain good and companies that's going to perhaps move from being good to being one of the worst. And I just want to illustrate this by looking at two companies that has been in the portfolio at points in time. And this is looking at the return on invested capital for Pick n Pay and ShopRite. And as you can see, in the financial years 2013-14 to 2017, Pick n Pay had an improving return on capital, so its ROIC was going up, whereas ShopRite in the same periods, ROIC was going down. Now, if you had a look at this chart here, for this period, 2014 to 2016, and this is looking at the relative performance of Pick n Pay versus ShopRite, you can see Pick n Pay significantly outperformed ShopRite in the period where its return on capital was going up. And if you now switch to the period 2019 to 23, you can see that Pick n Pay's return on capital started declining, whereas ShopRite's return on capital was improving. And still looking at that same chart, Pick n Pay relative to ShopRite, what you can see is Pick n Pay starts underperforming. Pick n Pay starts underperforming ShopRite by a significant margin when its return on capital is declining and ShopRite's return on capital is improving. So very important to try and understand what happens with companies moving, return on capital moving over time, because it results in significant changes for shareholders. And these are the type of things that we're considering all the time. So it's not just as simple as to say, you know, you're a quality investor. It is also about how quality perhaps moves over time. And so that's it from me. I'll hand over to Richard, and he'll take you through more of this in terms of the global side of things.
Thanks, Walter. So, yeah, I think I don't need to go back into how we think about investing and our approach. Walter has explained that. But for us, you know, when we think about quality, what we're thinking about is value creation, or economic value creation for investors. And to our mind, the only way that that can happen is the extent to which the company's return on invested capitals exceeds the cost of its capital. So it's a self-evident point, of course, that, you know, high return businesses are typically not cheap, often quite expensive. And that is often the kind of rebuttal about the quality approach. But I think what people sometimes miss or don't quite think about is that if you have a business that has high returns and it can grow, and this is why the growth vector is so important for high quality businesses, what it is then doing is it's reinvesting its capital at effectively a book value as opposed to a market related price, which is obviously a more inflated price than the operations themselves. So that's very important. So in terms of searching for value creation, we start by looking at the returns on invested capital. We're looking for earnings and revisions trend. We're looking for momentum in the operating aspects of the business. And we're looking for growth opportunities such that the company can exploit these high returns that it has within its business. So if we can just jump forward to the next slide, please. So aside from it being, we think, good business common sense, it's also worthwhile to look back at history. And this is another way of thinking about, I guess, the two tables that Walter showed in terms of transition probability from high returns to low returns, in fact, the underlying returns on capital of individual businesses tend to be more sticky than perhaps what the market expects. So here we're showing a risk and return of various strategies, the risk being the probability of a 12-month negative return, and the return just simply being the annualized performance looking back 32 years. And what you can clearly see in the top left-hand corner of this chart is that high quality, whether it be quality with growth or just pure high quality, is clearly a very good place to be on a risk-return basis. So I guess the next question is, in terms of applying the strategy, how has it worked for us? And if you could just move forward, please, Walter. So we've been managing money offshore in this way going back to 2008. And I was, in fact, managing money offshore prior to that. But the launch of the BlueAlpha Global Equity, BlueAlpha BCI Global Equity Fund in 2014, over that time, we have managed to outperform the index, which is in itself has been quite a challenging index to beat, the MSCI World. And versus our peer group, we've exceeded them by about 3% on a compound basis. So over time, that's a substantial difference in return. More recently, our returns have lagged a little. Sorry, if you could just go back, Walter. And the explanation for that, or the unpacking of that, is I think our portfolios did extremely well going into COVID, as you would expect. These are very robust, in many cases, high quality businesses that exhibit defensive characteristics. They generate lots of cash flow, very high returns. And coming out of COVID, where there was let's call it a risk on rally, as well as a valuation expansion, we've been a bit more cautious in that respect. And I think a combination of sticking with our quality approach, but not wanting to pay too much, given the risks that we see on the valuation side, has led to a little bit of relative underperformance, but still very good returns. Now, perhaps a more interesting way to look at our performance is versus quality itself. So here we track the fund versus Morgan Stanley US Quality Index, which is the US is where we tend to invest most of our capital. And simply to say that since inception, we've delivered about double the return of the factor itself as expressed in this index. And given that we will through time stay with quality, this we feel is probably the most appropriate way to assess the manner and extent to which we have delivered on our particular style. So how do we do it? Like all fund managers, particularly those who are looking at many companies all over the world, we use extensive use of screening. In our case, we start with a broad global universe. We have a cutoff of $10 billion. It's not explicit. We can invest in companies below that, but from a screening perspective, we tend to cut off there. And there's no secret magic to that. It's simply a factor of our view that companies with the market cap over 10 billion would typically have a history that we can analyze and actually look at the economics, which is important for us. And also there'd be sufficient research that we wouldn't be, let's say, overly disadvantaged sitting in South Africa and looking at companies all over the world. So in terms of our portfolio, it's unlikely that you will find companies that you've never heard of. We don't want to go and look for a gem in Vietnam, thinking that it's a special opportunity. Meanwhile, the people in Vietnam know that it's actually a fraud. We then do our factor screening. And as Walter mentioned, the order of the screening is very important for us. So, if you screen first on value and maybe towards the end on returns, you're going to get a very different ending universe of opportunities than if you start with quality. So for us, we start with quality, we then move to growth, operating momentum, and then we look at valuation. Obviously, even the very best companies at some point have a price that is just going to make it very, very difficult to generate good returns. And basically through screening and then ultimately a qualitative process, which is, quite typical, company reports, presentations, really just trying to understand the dynamics of the business in more detail. We finally land up with a portfolio of 25 to 30 stocks. So quite quite a punchy portfolio, I guess, and you know, quite a long way from a broad market index. We are not index huggers at all in the global space. And I think the attraction for us is that certainly in terms of our style, it is easier to express the style more clearly than it is in South Africa, where one has to make adaptations given the skew within the South African market. So just moving on, in terms of looking for ideas, I thought it might be interesting kind of just to put some visuals to this. This is just a screenshot of one of the screens that we use. You'll see it's a Holt product. We also have kind of adapted the same process that runs off Bloomberg, so it's not that we are reliant on Holt. And if you look at the company in bold, United Rentals, and look at the first few columns, you will see based on operational quality, operating momentum, and valuation, the company screens incredibly well. So very high quality, good operating momentum, and the valuation is attractive. In terms of valuation, when you have a low number, that would mean that the company is very expensive. So no surprise, based on how we're looking for companies, that there's a lot of quality. In fact, it's all quality on this table, and some kind of typical suspects you'd all be familiar with. Novo Nordisk, not a company that we own, but you know, very high quality business, but expensive. Higher up on the table, Hermes, you know, it's kind of defined as quality at any price. So high operating quality, good operating momentum, but very, very expensive. So that's the kind of business that we would kind of stay away from. So this was one of the triggers for us to start looking at United Rentals in a bit more detail. And if we could just jump to the next slide. So United Rentals, for those of you who don't know the company, is one of the largest equipment rental companies in the world. It has good return on invested capital, and through time, its return on equity has been about 30%. And we think it's a business which potentially could be resilient in a recessionary landscape. And obviously that is something that's, you know, quite appealing within a portfolio at this point. Why could it be resilient? It's a company which would benefit from infrastructure stimulus. And we know in the US, there's a drive towards onshoring, whether it be in the semiconductor space or energy, as well as expansion into markets like electric vehicles. So company with around about a 10% free cash flow yield. It has excess cash. Its leverage target is about 60% of where they like to run at. So we see a lot of potential for share repurchases, potentially, and maybe even strategic acquisitions. In terms of the two charts we're showing here, the one on the left in gold, you see the return on invested capital, which has been trending up over the last 2 years. And the forward PE multiple, just as a very kind of blunt proxy of valuation, has been trending down. So that's, you know, it's interesting to look for these kind of differences opening up between valuation and actually the operating environment of the business. And on the right, we show the company versus the world index, the blue line being its earnings forecast going forward versus the world index. So you see that is in an upward trend. And then the gold line is the price relative. So essentially all it's telling you is that on a valuation basis, the company is getting cheaper and cheaper. But it's good to see that the earnings relative is doing well. If we could go forward, please. This is probably one of the most important tools that we use internally, where we analyze our portfolio versus the top 1,000 global stocks by market cap. And really what we're showing is on a factor basis how the portfolio stacks up, be it on quality, valuation, in terms of EV to free cash flow, which is our chosen way of looking at valuation, operating momentum, and then growth. And clearly you can see we are very skewed or overweight quality, which is, you know, intentional. And we also have good operating momentum within the portfolio. And then on the right, we just show the return on equity of the portfolio versus the world index. So not quite double, but significantly above the world index. Next slide, please. Another interesting way to look at the portfolio is to, on an aggregated basis, have a look at the EPS of the portfolio through time, how that's developed, and you can see that's been fairly robust. And on the right-hand side, the portfolio PE multiple. So essentially, our portfolio has got cheaper through time, which we think makes it more attractive than the market index. And that's probably a function of some relative underperformance recently. But if you look at the bottom table and you think about the return on invested capital, you can see the portfolio is about twice that of the market. So a portfolio with attractive returns, quite cheap valuation, and good earnings momentum. Now, we always get asked about forecasts, and I think, if anything, the last 5 years should have taught us not to take our own forecasts too seriously. We always struggle with forecasts, particularly of a macro nature. But we do have two kind of thoughts, very simple thoughts. One is about tech. We think tech is broadly looking quite expensive. And I don't need to explain the factors that have driven technology recently, the sort of fervor around artificial intelligence. Here we're showing the S&P Technology Index in gold versus the 10-year real yields, which are inverted. And if we think back to the story through last year, which was effectively a higher discount rate meant lower valuations for businesses that were going to earn their money further into the future, or kind of highly rated companies. That's been turned on its head recently. And in fact, we have reduced some of our technology exposure over the last couple of months. Unfortunately, some of it kind of prior to the AI excitement. But nonetheless, we do think that there are some valuation issues ahead for technology. And the next point is really just about interest rates. You know, I don't think it's worth our while to debate whether we're in a new bull market or, you know, whether a bear market's on its way, but simply to say that over the last 40 years, we've never seen rates go up at this pace and to this extent. 14 months, 5 percentage points of rate hikes. And typically what happens is when the Fed raises rates, something breaks. We saw potential signs of this early in the year, in March, with the US regional banks. That seems to be put to bed, but nonetheless, bull markets don't start with the Fed raising rates. So we would suggest some caution is appropriate, and you know, invest very carefully in businesses that are not dependent on the broad stock market cycle. So you know, that's a bit of a negative message, I guess, but I would like to leave you with a positive message, which is that there are many very attractive, in often cases, very boring businesses with good returns that are worth investing in right now. So this is Pool Corp, a distributor of pool-related supplies, accessories, cleaners, and pumps. And clearly, during the time of COVID, the company kind of started earning excess income as people, you know, started spending money on their homes. And with that, the valuation went up, the blue line showing the forward PE multiple, so over 40 times. It's now fallen back to 10-year lows. And it's a very interesting business. As I said, a very straightforward, boring business, but with a long-term track record of high returns, which we show in the gold line, return on invested capital. So kind of, you know, 25%, between 25 and 30%, and a return on equity of over 50%. What's interesting about the company is it's never cut its dividend in 19 years. And over the last 10 years, it's grown its dividend by about 20% compounded. It's also bought back 20% of its shares. So what that tells you is that the company generates a lot of free cash flow, and it's using the cash flow to pay dividends, reinvest in its business. It's made many acquisitions through this time as it sort of consolidates within the industry, and also buy back shares. It's currently buying back about 5% of its shares per annum. So the message, and I've probably gone on too long, is simply that there's always risk in the market, but at the same time, there are always opportunities. And this would be an example of one of the kind of opportunities that we have in our portfolio. Thank you.
Great, thanks. Morning, everyone. I am going to catch you up on what we're seeing on the local equity space. If you can just move one slide on. So I think in industry, as well as a lot of sort of financial journalists always refer to SA Inc. as it's almost as if it's one share. We wanted to formalize that definition just as a tool for understanding about where that basket sits in our market. So we thought, let's create a SA Inc. index. That's about 30 names in the industries that you see above you there. And it's not exhaustive, but we have put on some market cap restraints to make sure that this index is responsive. And what we're trying to show here is that, can we capture a single basket that's going to be the most responsive to an increase in domestic demand, and definitely be responsive in case of demand decreasing, which is more likely the case than not. So on the next slide, we want to take a look at how this SA Inc. index is actually fared over time. We look at its price index to start. It's what I think everyone's interested in. We definitely note, I think your eye is going to be drawn to what is actually a range-bound pattern since about 2014. And the high of this entire series sits at the beginning of 2018. That was the Ramaphoria moment. I guess we can call it euphoria in hindsight, knowing that that's actually the highest point in this entire series. If you had invested then, you'd still be underwater in this SA Inc. basket. The earnings is also telling a story, but maybe a different one. When we've combined all the earnings of these businesses together to create some series to give us sort of sight of the trend that we're seeing with SA corporates, we do see that they are marching ahead of COVID lows, but there is a little bit of a resistance for a lot of sell-side analysts, we feel, to be a bit harsher on 2024 numbers rather. So there is a bit of optimism still baked in. It may be surprising for some to hear, but we're not seeing a lot of downgrades happening on the further dated numbers. And so what that means is that there is perhaps more risk to estimates. As you can see, maybe the absolute depths of load shedding have, if you can just go back, sorry. Sorry, Walter, just back, thanks. We're starting to see that EPS forward index slightly tip off at the very end over there. It's just something to keep track of. We are cautious of it. I think a lot of people in the industry are aware that the market is pessimistic. There just may be more to come still. Another way of looking at it, next slide please, is just a crude measure of upgrades and downgrades through time. And this we find quite informative. So again, we're looking only at the SA Inc. index. We're looking at these 30 names that are sensitive to domestic demand. And on the upper half of this chart, in positive numbers, we have the number of upgrades. This is just number, not size, just a crude count over the preceding 3 months. And appropriately in the negative is the downgrades. And this line that we have stretched across the chart is the net count. So what we're seeing here is that over time, there's actually been a slight bit of pessimism creeping in, a weaker sentiment. Downgrades have been more popular than upgrades, and definitely reaching their low, as we can all understand, at the depths of COVID. Since then, we have improved, but again, that recovery has been short-lived, and unambiguously now there is a negative sentiment around earnings. And if you maybe are picking up that the left part of the chart seems a bit wider than the right part, I think that unfortunately reflects the lack of coverage that has somehow crept into the SA Inc. market. There are just fewer brokers interested in business this side. So a signal in itself. Next slide, please. So that's what the sell side says. The buy side, looking forward in terms of PE, we are at decade lows in the SA Inc. basket. During the most recent sell-off, there was probably about a lot of them trading at single-digit PEs. So this is quite remarkable, but it is nothing new. You will notice there is a trend. SA Inc. has been derating since about 2018, even if you had to walk through COVID. It's a trend that doesn't seem to be abating anytime soon. So with that all in hand, and that's the lay of the land, how do we think about this in our quality perspective. So you would have noticed that Walter talks a lot on ROIC, and ROIC, return on capital. It's a pretty important metric in our process. We don't sort of, the process doesn't live and die on it, but it gets a lot of oxygen from it. And what we've done is, again, sticking with the SA Inc. index, because we think this is an important thing to keep track of, especially in a domestic mandate, just where the ROICs are measuring within that basket. What's the median? What's the 25th percentile? What's the 75th percentile? And if you notice, I have done a bit of sort of dark magic here with the y-axis. I've put that line at about 12%. So that would be what we estimate the cost of capital would be on average for all businesses. And below that shows businesses, SA Inc., on average, not making the return. Above it, they are, of course, meeting their costs. And what we see now is that there actually is small improvement. These are businesses that have been able to fix themselves, but we're not fooling ourselves into thinking that this is a huge bounty of opportunity. True quality is very rare to find in South Africa. It is a difficult thing to implement at the moment, but what it does make, and this is the other side of that coin, is that it makes those opportunities all the more valuable. One thing to mention here is that we aren't going to be dogmatic about cutting off at a certain line. Certainly we don't run a business by means of just a spreadsheet. We are a quality growth investor. So businesses that are able to grow out of their current states is also something we value quite a lot. For an example, and we unfortunately don't have a slide here, but I think it's to everyone's common knowledge that Woolworths' acquisition of David Jones was severely value destructive. And if we had to tease out the underlying ROICs of that business, the original Woolworths business would easily be in above the 75th percentile in the SA Inc. base. Added with the David Jones acquisition, that puts it firmly below the median. So on aggregate, that group is not necessarily the highest ranking ROIC business, but we do realize that with the sale of that and the growth that they can still get done, it does fall very easily into our investment universe. So this shows a very narrow set, but we are finding opportunities. And again, a very important slide for us, and this is where we'll end here, is that our business is focused on quality, but we can't do that at the expense of everything else. We have found that in order to maintain a balanced approach and be sensitive to the markets, we are always exposed to quality. This will always be the highest, but growth may sometimes be harder to find. And that's probably where the challenge comes out of in our quality growth axis. Otherwise, what I can tell you here from the fund is that the momentum seems to be the highest. We had a question from a client once if this means we're just chasing performance. No, this is purely because there's a lot of parts of the market that are really underwater, and it's a matter of metrics as why the fund screens so high in momentum. We are aware to always cut our positions if we find that the market's moving against us, but in no means is BlueAlpha a momentum house. Just want to clear that up. And the last two bars on the right, this tells a fair bit of story here. PE is never really the metric we want to focus on. I know we've shown it in a few slides, but I think that's more about its ease of communication rather than its usefulness to us. So on the far right, you'll see this fund has a negative bar around the PE value metric. What that means is that the fund would actually still screen expensive relative to the market in terms of PE, but to its neighbor, the free cash flow, the fund actually screens cheaper. And this is our preferred metric and how we plan to construct the portfolio. You'll always see us preferring a free cash flow yield versus a PE. So with that said, I think I've covered a fair bit on our local equity fund. Want to hand it over to you, Eugene, if there are any questions.
Yeah, fantastic. Thank you very much. There's a couple of questions coming in from the audience. I've got a couple of questions as well. Maybe if we can stick to that, Carl, I mean, if you showed now your metrics of the fund and where it sits, a very interesting question from Tavonga from BRP that came in. And I'm going to pose this question both on the local and the global equity, because I think it's obviously relevant to both. And it is asked, which areas within your quality universe and presently reflecting the highest momentum signals, and also then the lowest momentum signals, and what are these momentum signals, and how does this affect your present positioning and outlook? Bit of a loaded question there.
So he snuck 3 in for 1. Okay.
Yes.
So first, I think to just jump on what we refer to as momentum is going to be a combination of price and earnings, short-term earnings revisions. In that price, there's a crude change metric as well as a trend metric. The areas within the quality universe that are probably showing the best is we have across the BlueAlpha stable, and specifically in the SA equity fund, we've been very fortunate to capture a lot of the upside in Richmond for a start. This screens high, and I think this is perhaps the second largest stock in that fund. So that would drag up the momentum score quite a lot.
Yeah, if I can just add to it, Eugene, again, it is also relative, so it would be also not capturing big downgrades. So, for example, if you measured it across the fund, which obviously will now be broader than just SA Inc., you know, a lot of the materials companies are showing significant downgrades in earnings, and we're at the index level, we're underweight the material stocks, although we do have the likes of Billiton, Glencore, Anglos, but on a net basis, we're underweight that space. So yeah, that will also help in pushing higher our operating momentum score.
I think
Yeah, thank you.
On the global side, in the technology space, let's not talk about price momentum, but let's talk about operating momentum. And particularly if you think about the big cap tech stocks, year to date, that has mostly been a re-rating story. It hasn't been an operating momentum story. So we think, there's some risk there. And then in terms of sector-wise, where there is quite good operating momentum, kind of the likes of the companies that we showed, industrial companies, and interestingly, consumer discretionary is showing much better operating momentum than consumer staples. And part of the reason for that might be that, wealthy people who spend money on a discretionary basis are still very wealthy. Whereas there's another sector of the market of people who are buying kind of necessities, and that seems to be kind of slowing down a little bit. Yeah, just a slightly tougher operating environment.
Thank you, Richard. And that maybe leads into the next question also from the audience. And it speaks to how active you are in positions. For example, do you use a buy and hold long-term strategy when you find a counter that ranks well on your quality metrics, or do you have a high turnover, with example of or leading towards a momentum bias on quality counters?
So on the global side, the share turnover is quite low, probably 5%, there or thereabouts. And it's self-evident that if you think about our approach, we are relying on the businesses to generate the returns based on their underlying economics. Now, to flip it around, if you are purely a valuation person, then I guess valuations change quite quickly. But as Walter showed, the whole premise of our approach is that the operating returns of businesses change slowly. And to benefit from that, you need to be patient. So, and much more on the international side, because we have a far bigger universe of stocks to choose from that exhibit these high return qualities. Whereas I think, I don't want to answer for Carl and for Walter, but in the local market, it's also self-evident that you get these much bigger swings in terms of what's working and what isn't working. So yeah, you need to be invested in these businesses, particularly for a period of time, particularly as you're not buying them at very cheap prices. You're buying them, if you're lucky, you buy them at a market valuation, and typically you buy them at slightly higher than market valuation. And you want to benefit from them reinvesting in their own businesses.
Yeah. Maybe if I can step or stick to that, and I mean, Richard, you spoke to your screening process. You also briefly touched on AI. You reduced your tech exposure, but AI very thematic at the moment, and some might say it's getting into bubble territory that might go on for a very long time. Does AI come into your screening process when you look at companies, and or what is the impact of AI on future earnings of some of these companies that you might look at?
It certainly doesn't come into our screening process because basically we're looking for businesses that have a history of generating high returns. So, I understand that everyone's got very excited about AI all of a sudden, but it's not like this is a new thing. This has just become extremely topical recently. And I think it's an extension of technology applications. That's what it really is. Technology is not going away. It's a very important, I think it's essential for any business to adapt technology going forward, whether you're an energy company, materials business, or consumer-facing business. You need to apply the tools of technology as they are appropriate in your business field. But no, to answer the question, we have not incorporated a screening approach linked to AI at this stage.
Yeah, Eugene, maybe I'll add to that and just say that, obviously when we analyze companies, we understand what they're doing. So we understand that Microsoft has, very big AI capabilities. And then actually it has got the financial muscle to expand and improve and actually make money from that. So it's not as though we're agnostic to it.
Yes.
We don't have a specific screen to it, but we understand when we're analyzing the companies, the opportunity set or not.
The impact of that in the earnings, obviously.
Yes.
Question from the audience as well. How is the outperformance of the global fund relative to the quality index explained?
Must be our superior skill set. I can't answer that question. We have our process, and I think it's just, we show it just because I think it's relevant if you have if you have a particular style, or if you have an approach. There are times that it is more in favor than other times. We often we have sometimes in the past said, yeah, but you've done well because quality's done well, and that's why you've done well. Or, of course, that is true. If you're a small cap investor and suddenly small cap does very well, then you will do well. But so I think it's just we show it as a check to say that we are actually outperforming the factor if it was kind of applied without much thought process, or without much research and qualitative discernment.
Yeah.
Typically, those factor funds would look at something like a ROE and apply it broadly as the mechanism for quality, or they would have low gearing as one of the quality factors. And we're very specific as to what we're looking for. We're looking for economic profit, and we're looking for growth. Now, most of those quality indexes won't have a growth element to it. They'll typically just, and it's not a dumb thing, but it's a machine driven thing. And so hopefully, as Richard said, some skill and some other factor overlays hopefully will make us outperform the machine that just invests in a basket.
Yeah, and I mean, part of it answer was in your presentation as well, Walter, where you explained your process. There's been far more to it. So yes, it does boil down to your process and skill, obviously. Another question from the audience, and again, Richard, you touched on it briefly. Bull markets as a start with the Fed raising interest rates, and I mean the Fed made it very clear that they are going to continue to take liquidity from the market. But if you have, or how do you protect against permanent capital losses in a pure equity fund if you mentioned there are more caution in the months to come?
Well, I guess the word permanent, when you use that word, you must also set a time period. So are we talking, 1 year, 10 years, 30 years? What I will say is if you invest in bad businesses that are living on borrowed time, that is a guaranteed way to assure permanent loss of capital, regardless of what the stock markets do. And, notwithstanding, say, in the global space, very strong markets over the last 10 years, there have been some absolute disasters where you've lost all your money. So I think that, we like to talk about the idea that if you invest in a business with low returns, even if it's very cheap, you kind of, you're living on borrowed time, and you need to be very, very careful about your exit, because the longer you stay invested, the more risky it gets. I'm not talking about market risk. I'm just talking about idiosyncratic business risk. And I think if you, I know that if you're invested in a business with good returns, long track record, generating lots of cash flow, reinvesting for growth, look, we're optimistic people. So, we're not sitting here worrying about the end of the world. And that in itself is an easy bet. It's a bit like the Russia story. There's a reason why stock markets do not respond to Putin's nuclear risk if it exists. And the reason is that it's not worth betting on. I mean, if it happens, then buying stocks is the least of our problems. And, if markets go down on that basis, then buying stocks is the best idea, because we get through it, stocks will go up, a bit like COVID. So if you invest in a good business with good returns, the risk of short-term loss of capital, mark to market, is always there on a 1 year view, on a 2 year view. The risk of long-term loss of capital, I would say, is almost zero based on history. So that's the point. We must go and look for. It doesn't help to spend too much time debating these macro factors, because our job is to try and find the best investment opportunities at any point in time. And I hope in a very short presentation that we showed that there are many really interesting opportunities, and maybe they fall by 10 or 20%, but so what? That's not permanent loss of capital.
Yeah, I think, Richard, that point is very valid. There might be short-term cycles, but it's all about, can clients make money off the companies you hold over time? Exactly that. Maybe for the last question, there's a couple of questions that we will circulate through to you as well, if you want to comment on that, a couple of open questions, but we are running a little bit out of time. Maybe for the very last question, and it's asked, do you think it is still prudent for a global fund to invest around 70% or more in the US?
Again, you keep asking me the questions and you get long answers. I mean, it's self-evident. Everyone can look at the valuation metrics of different markets, and we know that the US is relatively more expensive than Europe, Japan. This has been the case for quite some time. People have told me that the dollar is going to lose its dominant position for many, many years. And I've heard the same thing about the US market. Who's to say? What I will say is that I do think the US economic environment is one of the most vibrant capital environments to operate in, A. B, many of the companies that we invest in are not exclusively US companies. These are global businesses, so they have global reach. And, I think it comes down to the underlying investments that you're making in businesses. So again, we are not macro players. We don't have any direct Japanese exposure, for example. The Japanese market, people would say, is very cheap. I think it is cheap where there's low liquidity. Where there's reasonable liquidity, it's not that cheap. And it's a nice story that the Japanese culture is going to suddenly change overnight, and they're going to become very return on capital focused. I think let's wait and see. So no, my short answer is I don't think it's imprudent. And we're not investing based on our macro oversight of emerging markets versus developed markets, Europe versus US. That's not our approach. And I think we find, we have been looking in Europe, and if we find a business with the right kind of returns and the right kind of growth, we would certainly invest in it. So it's not that we are dogmatic about it at all.
Yeah.
And the one thing that we do like is in the US in particular, you get a lot of continuous feedback from the companies with quarterly reporting. So, it's in many ways, it's easier to keep your finger on the pulse from a sort of information flow point of view.
Thank you, Richard. Maybe very, very last question to Kyle. And Kyle, if we looked towards the end of last year, beginning of this year, a lot of hope was placed on the unlocking of China, which proved to be more sluggish than what people hoped for, and how China could potentially benefit emerging markets, including places like SA. Where we are now in terms of global markets, and like I said, with China's unlocking being more sluggish, where will some of the bigger benefits come from a SA equity investor perspective? Do we need to bother with things like China assisting our markets, or are there enough scope in our markets in the companies that you hold to give clients decent earnings?
So I think first I'll just say that I agree with you, it has been sluggish. It's worthwhile mentioning, because this ties on very nicely with what Richard mentioned earlier, is that we're not sort of trying to bet on large macro swings, rather just the companies that we can identify that already have the metrics that we want today. And that means when we look towards China from an SA equity perspective, the obvious story that's always been played is a Naspers process story. This is one that we have not felt is necessarily the most appropriate way to play China. And as a result, we've stayed rather light there, amongst other reasons as well. The case for base metals as a respondent to China's is also something that we find is a little bit of a weak linkage. They themselves have mentioned they want to be focused more on consumer than industrial production. That industrial production was never halted to the same extent anyway during COVID. So how much slack it has to pick up still has to be seen, although it's probably operating much closer to capacity than people think, or much closer to potential, I should say. So it is, unfortunately, it's a narrative that I think a lot of SA investors would like to capture. However, the ability for us to truly make sense of it from these sort of neatly packaged ideas is perhaps a bit limited. Ultimately, if China does come to the party and you have these forecasts, and they do come true, of about 6%, we're seeing some banks say for GDP, that ultimately does boost a lot of general stock markets and sort of upside. And so that we are positioned for, because in the essence, South Africa is still an emerging market itself. We should not try to look for emerging markets elsewhere when you have a lot back home.
Yeah, Carl, thank you for that. Gents, we are very much out of time. Unfortunately, there's still a whole bunch of open questions from the audience. But like I mentioned before, we will circulate these questions through to you. And if you can, and where appropriate, maybe just provide short comments on that, and we'll send it back to the audience members as well. To our audience out there, thank you so much for joining us this morning. Just a quick reminder, next week, Wednesday, 19 July, we've got Saffron Wealth, and we'll continue our discussions. To our BlueAlpha team, thank you so much for joining us this morning with all your insights. And to our audience, again, all the BlueAlpha funds Walter showed you their product range are available on all the big list platforms. If you want any additional information on BlueAlpha, more than welcome to make contact with us, and we'll get you in touch with one of their team members. To Walter, Richard, Carl, thank you very much for your time this morning. Stay safe, and we look forward in discussing matters with you again very soon. Thank you.